Hello, everybody. Kirk Spano. It is Monday, August 5th, 2024, and the world is ending again. Oh, I hate when the world ends, except when I have cash and I can buy stuff that other people are selling. So there's that. All right, at the start of the year, I said there'd be a rally, then angst, and then another rally up to euphoria. Well, right now, we have seen the first half rally with only a little breathiness in April. And now we are starting to see some pretty serious market angst. This morning, when I woke up, I checked Bloomberg, and stock market was down like 6%. And I was like, oh, okay, they're selling overnight. That might be the end of it by lunchtime. And here we are, only down 2%. So there's been a big comeback. I did a little bit of buying near the open. I actually trimmed a little bit of AST Space Mobile because it was up a buck. Not because I think there's any reason to trim it, other than I wanted to put some money in other places, and I manage other people's money. So in my personal account, I did not sell any. However, in client accounts, I brought the asset allocation back down to 12%. And I will tell you, until it gets back into the 20s, which is where it sniffed a little while ago, I will not be selling anymore. I want to see this stock become bigger. And frankly, I will probably sell puts on AST Space Mobile if I get a chance when my other puts that I've been selling expire. So it really all comes down to asset allocation. You don't want to have just, 5 stocks. You're trying to build some balance there. Now, my investment portfolio is mega caps on one side from equities, and then small and mid caps that I pick out individually. From time to time, I'll buy a large cap individually, but not often. For the most part, the mega caps have been leading in the S&P 500. We know that 10 stocks, when you take the Magnificent Seven, and I believe you add Salesforce and a couple others, have been most of the gains in the stock market. Something like 70% when you expand the Magnificent Seven to the top 10. And I want to own QQQ because those are the most cash-rich companies. And what do cash-rich companies do? Cash-rich companies buy back stock. And right now, this is where we are. We are during the buyback blackout period, which starts about 2 weeks before earnings and goes to a week after earnings for individual companies. So we're past the peak on S&P 500 buyback blackout. And within, a few weeks, we're going to be back to buying shares back. Now, NVIDIA's earnings are when? The very end of August? So that's one giant stock that won't be buying back until September. But the rest of them have been reporting, and so we're going to see buybacks pick up towards the end of the month and into September. So we've got about 3 to 4 weeks of choppiness left in the stock market. We have Jackson Hole coming up, which I think the Fed chairman and others will make it very, very clear that they are going to cut rates in September and that it'll be a 50 basis point cut. So in the middle of September, you are going to get a 50 basis point cut to the Fed funds rate. 2-year treasuries are already starting to reflect that. It's already priced in. And then here's what I think is really going to end up happening is I think you're going to see the Fed cut rates as fast and hard as they did, but the opposite of when they raised rates. So you're going to see interest rates come down 2 points by summer next year, I think. I think you're going to see a series of 50 basis point cuts before they taper it down to a quarter point, maybe late next spring, early next summer. And there's a couple of reasons for that. And I'll go through those in a second. And what you're going to see is that while we are going to get a bad few weeks in the market, maybe every quarter, for the most part, it's still going to be up and to the right because earnings are starting to expand. On Saturday, I showed you that earnings were starting to turn up after about 2 years of being flattish. And that means that these PE ratios, because the E will rise, means that the price to earnings ratio comes down. So even though the S&P 500 has a price to earnings ratio after today of about 19, right, because prices came down a bit, as earnings go up, you can not only see the valuation of the market come down, but you can still see the actual price go up because the earnings will keep up with the price appreciation. One of the things I'm writing into this article is what are traders' narratives? And traders' narratives to me, the way I make fun of it, is that you have traders who want to justify what they did yesterday and what they're doing today so that other people will help them make money tomorrow. And most of the traders' narratives are mostly wrong most of the time because they're very short-term in nature. They're not really grounded in fundamentals. They're technical traders who try to attach a fundamental story to things that is usually pretty half-assed, or just truly doesn't make any sense if you take a more circumspect perspective. And I think that it's important, and I've pointed out the book from Schiller on narratives and I'll put that link in here. I really think you should read the book or listen to it on Audible. But Schiller's book on market narratives and how they shape events in the very short term, how they steer the longer term just a little bit, because if people believe it, it tends to follow suit. But traders' narratives are really there to help you make bad decisions. So you pretty much want to ignore them. One of the things that we have in Shooter's articles that I've asked him to do is talk about the traders' narratives that are out there that people are trying to use to justify their trades. And again, it usually doesn't matter. It's usually technical in nature and also a function of market liquidity. So we have seen market liquidity tighten up just a tiny bit, and suddenly you have some carry trades unwinding because interest rates in parts of the world are changing, and those carry trades have to be rejiggered. So you saw a massive sell-off in Japanese stocks in the last couple of days, I believe about 15%, and Europe has actually held up relatively well. But Europe is at huge risk just because of the large secular problems they have. You know, they are basically a choppy market in perpetuity. And Japan, because they are challenged in a world with a little bit less globalization, because they're an exporter, they have to figure out how to make money and support their markets in the long term. And one of their tools has been print money and buy their own stocks. As their population completely flattens out, and as more people are drawing out than putting in, which is already happening, inevitably, you probably see Japanese stocks chop sideways, maybe for 10 to 20 years. It could be a very long chop for Japan. The big gains that they just made, that Berkshire Hathaway is pretty famous for investing in some of their brokerages and trading houses about 5 or 6 years ago, that trade's pretty much over. And Berkshire, I think we're going to learn, sold even more than just Apple. They're up to a record $277 billion in cash. And they also are the largest or second largest holder domestically of short-term U.S. treasuries, the notes and the bills. So that means that into this market, you have Berkshire Hathaway at some point going to sell a lot of the short-term debt and take those profits and then turn around and buy stocks. So you have a massive buyer of stocks poised to come into the market sometime soon, and they have a favorable deal with the Treasury, which, as I discussed the other day, is expanding Treasury liquidity, which is where Berkshire Hathaway plays. So Berkshire Hathaway will continue to be a good investment because they are getting favorable treatment from the Treasury because they're a huge buyer of those notes and bills. And now there's a refund mechanism in place that they're increasing quarter over quarter. And lo and behold, Berkshire Hathaway is going to be one of the companies getting a lot of that cash. Go figure that maybe the insiders get an advantage. So if you go to fundamental trends and you put in QQQ and search, you get a bunch of articles that mention QQQ. Pretty neat, huh? The article that I want to take a look at is there, Major Markets Elliott Wave Analysis, because I want to take a look at QQQ. Now, TLT, people get all breathy about TLT, and yeah, it can go up 10 or 20% as interest rates come down. But really, as I discussed on Saturday, long-term interest rates are fairly well anchored into a narrow range. Can you make around 20% if rates come down on the long end by a point? Yes, but if rates come down by a point, that's about as good as you're going to do. We're probably not going to see zero interest rates again, which is where these gains came from. And I do wish that Shooter would show a longer-term chart, because what you'd find is that right about here, historically, is about as good as it gets. So 120-ish on TLT if we get a recession. It's not a complete collapse like COVID. It's a little bit of money you can make, but really you're banking on a recession. I'm not going to bank on a recession, and I'll show you some proof that we're probably not going to get this recession, just like we didn't get the last recession, and just like we didn't get most of the last recessions that have been predicted by all the perma bears and people who want to make a name for themselves, peddling doom and gloom. And by the way, their newsletters sell. The dollar has been choppy for a while, came way up here, corrected, bounced back up, and this is probably what we would consider a ending diagonal, I think, which means that we're probably going to get it to fall a bit over time, but not a lot. Can we see the dollar get all the way back down into the 90s? Absolutely, and that would be very supportive of stocks without stimulating inflation. I think that's probably going to happen, and I think that we probably see some sort of move in this direction over the next several years. That's good for equities, probably good for Bitcoin. Don't really care about the S&P 500, but let's take a look at QQQ, the one I am interested in. Why do I like QQQ? Because it's pretty much for the last 22 years outperformed SPY, and I would expect, except for short periods of time, 3 months, 6 months, every now and then a year, but generally not longer than 1 or 2 quarters usually, QQQ will continue to outperform SPY. Like I said, it's rare that QQQ doesn't outperform SPY over periods that are longer than about 6 months. So what should we expect? Well, at the end of the 2022 bear market, QQQ got down to around 300-ish. Can that happen again? Sure, absolutely, it could. However, it's a self-correcting index like market cap weighted indexes are, because the best companies just keep getting added. So as a company goes up, the index continues to add it, basically pyramiding up their positions. And I've talked about pyramiding up your winners. It's a great strategy because you're just adding the winners. Now, from time to time, you have a market dislocation. And that's when you go, oh, I should have trimmed some at the top. And yeah, I mean, 3 weeks ago, I told you to trim some at the top. I don't know if anybody did. I can only say what I say. And here's what I'm going to tell you now. You should be looking for entries into QQQ because those top companies have monopoly pricing power, huge balance sheets, and their earnings are suddenly starting to go up again, mainly because of AI, which is a real thing that's going to change the world the same way that the internet did, and probably more. So when Microsoft spends a lot of money on semiconductors to power their AI, NVIDIA makes money. But then Microsoft starts to make money because of what they've invested in. I just bought Copilot from Microsoft, and I will tell you, it's pretty awesome. It is better than ChatGPT because it is based on that technology, and they've integrated it with their search engines. And from what I can tell, I'll be paying that $20 a month for a very, very long time. I also took a look at another AI software, and I'd like you all to check it out. Check out Copilot, and then the other one that I just signed up for, and I'm not paying for it yet, is called Perplexity. And it seems to be pretty good for research. So if you want to check out Perplexity and ChatGPT, the paid version, and Copilot, the paid version, and any others, Gronk or whatever, I think that I'd love to hear your opinion. Teresa says she uses Perplexity. So I think that Perplexity and Copilot are the two that I'm gravitating towards. However, if you try others, I'd love to hear about it. Because I think for our purposes, the combination of having AI summarize things for us is great, but ChatGPT is only updated to the end of last year. What we want are integration with brand new information that have hit the internet, and it seems like Copilot and Perplexity are doing that much better. I don't know if they get the same day, but they are scraping very regularly. So you'll generally get data that's within the month, if not sometimes within the week. So keep looking at that. But QQQ, monopoly pricing pressure, I know that I mention it here and there. I don't always explain it. But when you have an oligopoly, right, few companies controlling a big market, they have pricing power. That's called monopoly pricing power. Monopoly pricing power doesn't mean that there's only one provider. It means that there's very few substitutes. So in the cloud and in AI, you have Amazon, Microsoft, and Google that do both cloud and AI. You have Meta, which is increasingly getting into AI. I haven't tested theirs really yet. You have NVIDIA building it for everybody. And if you are the CEO of NVIDIA and a few places aren't, ordering more, wouldn't you say something along the lines of, yeah, we're going to be able to replace any customer that walks away because we have a long list that goes for years. And if you'll remember, this Elon Musk character was begging us for chips in his earnings call. So I would expect that NVIDIA's earnings are fine. The market might find reason for a day to have a narrative that beats the stock up a little bit. But I think the reality is that NVIDIA is going to keep seeing that E rise. And while there might need to be some digestion between now and earnings, which I think the rest of August could be choppy, ultimately, I think that stock continues to go up. Meta, what the Zuck, he just keeps making money. It's hard to challenge these companies. And even with Lena Khan in government suing whoever she can sue for antitrust, hasn't had a lot of impact. So the most aggressive regulator that we've had in, I don't know, that I can remember, has had only a very minimal impact, slowing down some of the gas and oil deals. But really, we're getting close to peak oil and gas supply, so what difference does it make? What is more important with energy is that we have an all of the above strategy. The mergers probably make it more efficient for them to drill, and since there's a market, they're really not going to hold back. With QQQ, I had my orders in at 420, and we got down to 422. It just befuddles me how I get so close and just miss so often. I've asked Teresa and Shooter to put together some charts. I think that I probably get my 420. In fact, I lowered my price target to 415, not my price target, but my good till cancel orders 415 on QQQ. I did buy a little QQQ this morning in my ETF only accounts. And if the market sells off going into the close, I'll buy QQQ for the rest of my accounts. Because as I said earlier, I have a barbell, and really it's kind of a weird barbell because there's more than two arms. Think of it as like a jack with three or four. So on the one side, I have QQQ. I want those oligopoly companies. They're cash rich. They're going to buy back a lot of shares. And then I want to pick out small and mid cap stocks because you can't really use an index for small and mid cap stocks because the index contains so many crap companies. The Russell 2000 only has about 700 profitable companies and then dozens, maybe 100 others that will become profitable. And that's where your biggest bang for the buck is buying a company super cheap before it's profitable because everybody goes, oh, it's not profitable because they can't look 2 years out. And if you can look 2 years out, boy, oh boy, can you make a lot of money. Now, sometimes the time frame gets stretched out because of COVID or rising rates or regulation or policy that stretches things out. We've seen companies that's happened to. Highly regulated industries suffer from that. Now we are at the start of a increase in liquidity, not only through treasuries, but from the Fed. Interest rates are going to come down. And that generally means that the stock market gets a rally until about 6 months after the last rate cut. So if rate cuts go through next summer and then they stop because they're like, hey, we beat it, then maybe you'd have a correction in 6 months or the next year. I keep looking at 2026 and thinking to myself, ooh, that could be a rough one. At the end of 2025, a lot of tax cuts from Trump expire. Most of those tax cuts were good for investors. They weren't necessarily good for anybody else. I know that the higher standard deduction is good for most people, and they need to find a way to keep that. But almost everything else can go away because that was part of the spike and crash that we had started to experience right before COVID, and then COVID took the credit. And that should be a drag on equities for a while at some point because you'll have people selling right before those tax cuts expire. So at the end of 2025. And they probably don't buy back for a little while because they love to see a down year that they can buy into. Right now, I think it's a great trade to buy QQQ, select small caps and mid caps, and Bitcoin. And here's the thing with Bitcoin. It constantly gets explained wrong. I keep trying to explain it the right way. I keep getting proven right, but yet these trader narratives just keep coming. And they're wrong, and they're wrong, and they're wrong. Except for those days here and there where they seem right. Bitcoin is digital gold. It is starting to get used in the settlement of major transactions, think oil. It is being promoted by China and Russia and OPEC. OPEC has a lot of money. Russia is oil rich. Why they can have war. And China, for the big economic slowdown they've had, is basically net even. They're not a debtor. They have a lot of internal debt. They have a lot of external credits. So it roughly balances. And if they ever start consuming just a little bit more, their economy will pick up again for a generation or two before they start to get really old, like Europe and maybe even Japan down the road. But when you're a debt-free nation on net, you can spend 20 years saying, hey, go ahead and have more babies. We're not going to do that one-child policy thing anymore. And maybe if they feel good about their economic prospects, they'll have those babies, which means that in 20 years, you get a bit of an uptick in population in China. My guess, looking at the statistics, is that that's what's going to happen. And that the turnover and Chinese demographics will be lower and slower, basically drawn out over a longer period of time, and that the offset of more consumption will lead to a net positive. It's not going to be like it was 20, 30, 40 years ago, as they roared from being collapsed to being a power. But it will be a lot like Europe, choppiness, a lot like Japan, choppiness with an up tilt that finally looks like it might be having a down tilt. And as you look around the world at the major economies, the number one economy, the United States, still looks poised to do great because our population goes up anytime we feel like it, right? We take immigrants anytime we want because people always want to come here. Very supportive of the economy. In India, which is geographically in a pretty good spot between China and Europe and Russia. It has ports, major ocean ports, and they're young and they're educated and they want to get into the middle class. Now, they have lots of bureaucratic problems, and Modi's been trying to fix them, even though he hasn't been the most democratic guy. He has been trying to fix things. Some things he breaks, but most of the things have been getting better. So I would anticipate that India continues to grow, and that certain companies that IPO there will do very well. So QQQ, we'll see where it gets to. Will we get down to that 415, 420 range again? I don't know. I think for a hot minute. So I'm going to stick with my good till cancel orders for now until Teresa and Shooter tell me to raise those numbers. Make sure you take a look at the punch card growth stocks and the updates that I have put out on both websites, stocks of the week, stocks I'm adding to. And the options article is basically the same with the option trades over at Margin of Safety Investing. It's all one combined article. When you manage your volatility in Bitcoin, analysis of Bitcoin shows that while there's a little bit of downside, this Bitcoin and it's volatile by nature, there are pretty good support levels in the 50. Right here is about 56,000. Right here is about 50,000. I have a hard time believing it gets below this checkered line. I think it's right there now. I have a hard time believing it gets way down here. If it does, you really need to back up the truck. If you were behind on building your Bitcoin asset allocation, I think you should be nibbling in and decide, do you want it to be 6% like they always, 5 or 6% like they always told you should have in gold? Are you going to make it 10 or 12% like I'm doing? That's more aggressive. Are you going to buy it in non-brokerage accounts? I do strongly recommend that you have a Coinbase account. That is essentially the government-supported company in the business. Buddies with BlackRock, which is buddies with the government. You could do Fidelity too. I believe that they're letting you buy Bitcoin now. You want to make sure that you own the Bitcoin, and you should learn how to do cold storage. Because what you want are some Bitcoin for the very long-term future. And your long-term Bitcoin, you don't want to hold an ETF. You want to own that Bitcoin. You don't know what the world's going to look like in 10 or 20 years. And if Bitcoin becomes a medium of exchange for more than major international transactions, like I've suggested, there are South American, Asian, and African countries, even some Eastern European, where they are toying with the idea of just making Bitcoin legal tender so they can all buy their pizza with it. I make that joke over and over again. I still don't know if everybody follows. If you don't know the Bitcoin pizza story, go ahead and, look that one up. But if Bitcoin becomes a medium of exchange like dollars or euro or yen, I don't know how high it can go. Probably north of 1 million, maybe 2, 3, 4, 5, 6 million. It's 50-ish thousand right now. Even if it's just a currency hedge that is used for a handful of international settlements on major transactions like oil, I can't come up with a number below 300,000 in the next several years. I try. I've stopped trading it. I just accumulate it when I have money and it's on a dip. Now, that doesn't mean it should be the only thing you own, because that would be silly. But I feel pretty comfortable allocating 10 to 12% of my money to it. And actually, to this point, I haven't. It's grown to more than that, but I haven't put 10 to 12% of my money into it. This correction is a great opportunity for you to scale in over the next few weeks, maybe into September. But I really think Jackson Hole in a couple of weeks, they're going to make it very, very clear that rates are coming down, and the market will like that. And that will coincide with the buybacks picking up again. What I think is going to happen is as interest rates come down and facing the change in the tax code at the end of 2025, and this is a complex thesis, this one I can wrap my head around. You have a number of things lining up for a major rally after this correction. You're going to have the resolution of the election. You're going to have more liquidity from the Treasury. You're going to have more liquidity from the Fed. You're going to have executives very motivated to see their stock prices go up ahead of higher tax rates on them. And you've already seen some selling of stocks by executives take advantage of the lower tax rates, but you're going to see a spike, or at least an attempted spike, in stock prices before tax rates go up a few points. That has happened before. We have precedent in the past, and we know that a lot of executives care about what they make. So those buybacks are probably going to set a record next. One of the things that I have in this article is I talk about the buyback. And buybacks are already approaching a record, and I think we blow through it. I think you're going to see record buybacks next year, and then you're going to have, your commie fringe Democrats get very angry about that, even though it pumps money back into the economy. I still have a hard time wrapping my head around the idea that buybacks are bad because it's good for share price. If that money finds its way into private hands, they reinvest it somewhere. So why tell a company to expand when maybe they shouldn't? There is a reason the United States is super rich. It's because even in our manipulated markets, they're the freest out there, except for a handful of small countries. Markets work. Capital markets work. We have to regulate them so they're not abused by people who accumulate money and buy power. But for the most part, they work. And these buybacks are going to surge up. People will sell into the lower tax rates. There'll probably be a dip in 2026 if I had to figure it out, if I had to make a call on that right now. But then you have all that capital sitting there waiting to be invested in other places, which will probably be decarbonization. The private equity guys were talking about that at Hard Energy. The shift to an aging population in the United States as the last boomers get on Medicare and Social Security, and all things fourth industrial revolution. In particular, the implementation of AI across industry, all industry, even the French fry maker. So you really shouldn't look at this as a downer, what's going on in the markets right now. We know that the Federal Reserve is on the case. You can argue that they're a couple of months early or late all the time. But for the most part, take a look at your standard of living compared to 20 years ago, and it's pretty clear they've been mostly right most of the time, except when they are a little bit behind. And they might be a little bit behind right now, just like they were a little bit behind on inflation. But I've argued that they wanted that inflation. It's how you devalue debt. So I think you're going to see them cut rates pretty fast. They have said that the neutral rate is around 3%. I think they get there fast by next summer. And then we'll see what happens after that. I don't think we see 0 to 1% interest rates until the very end of the decade, when the last boomers are on Medicare and Social Security, and we have to have a crisis in order to fix it, because we won't fix it without a crisis. The Democrats will move a little bit close to fixing things. Republicans will ignore it or jump all the way to austerity and completely screw things up. But one way or another, we'll get our crisis down the road, print a bunch of money, fix things for a generation. There'll be a trade. There'll be a trade to make on that. It's not yet. What we do know is that there are no pickup in layoffs. So even though the unemployment rate has gone up because of immigration that I mentioned earlier, we're not seeing layoffs, even though we are seeing fewer job openings and fewer people quitting. We have a relatively stable labor market, and suddenly we have a little bit of slack that can go to fill what? What does well when interest rates come down? What does well in the real economy when interest rates come down, right? The Fed is focused on the labor market. There's an excuse. We have seen non-residential construction move sideways, and even residential construction kind of peaked. And we know that we're very short on residential real estate. We even need some more industrial. And a lot of stuff needs to be redeveloped just because it's old and grungy. Do you have a street in your city or a number of streets in your city where they're just a bunch of old buildings? They're not classic buildings. They're post-World War II buildings. They're just, they're a little tilted. They need to be torn down and redeveloped. If we're smart, we'll start to build walkable urban neighborhoods. We'll close some streets, take 4-block areas and close the streets in the middle, the cross streets. We'll see. There are a lot of neat things that can happen. But as interest rates come down, construction spending probably goes up. There's trillions of dollars in money market accounts, and it's not mom and pa. It's private equity guys and guys like me who are sitting on, $100 or $200,000 that's completely just earmarked for real estate development, and lots of guys with millions and millions of dollars. I'm smaller than a minnow. I'm what the minnow eats. Month over month, construction spending really fell off, and that's in the face of all this immigrant labor that we have suddenly available, right? But look, maybe these numbers are a bit skewed. Maybe we're going to see this jump up here. Let's find out. We'll have these final numbers soon. And we know that GDP is not falling off a cliff. So all these folks that argue for a recession, who are the same ones that argued for inflation, probably going to be wrong about a recession the same way they are wrong about inflation being a secular trend. We had inflation for 2 years after the most major dislocation financially of any generation alive, or the last one. No, I take that back. The last one saw the Great Depression. So there's not a generation alive right now that has seen a bigger dislocation than COVID, and it had knock-on effects, and that people still have a hard time reconciling the economic impact, mainly because they're like fighting over who should get a shot or not. We see that the economy is doing just fine. We had 2.8% GDP growth in Q2, and right now Q3 is looking like it's going to be in the two somewhere as well. So as the Treasury adds liquidity, as the Fed adds liquidity, as the buybacks pick up again in a few weeks, that means you have and as election resolution comes, and as the messaging from the Fed happens at Jackson Hole, that means that you only have a few weeks to buy stock. I think you should be getting to the point of being fully invested, right? You have your 4 or 5% cash cushion, but nothing more than that. You shouldn't be at 30, 40, 50% cash, and you should not be thinking about raising cash at this point. If you raised cash weeks and weeks ago, like I prodded you to, now you should be looking to be a buyer. If you did not raise cash, just take the rest of summer off. It's going to come back. Don't sell at the bottom. Don't act like a scaredy cat. Don't get emotional. I'm down 10%. That's my story, and I'm sticking with it. I've done a little bit of rotation, done a little bit of rebalancing, but I'm on net. I'm longer now than I was a week ago, and I'm looking to, because I own all the small and mid caps I want. There's a few REITs that I still want, but really I want QQQ and a few REITs. That's what I'm left with. But I put out the articles with the list of stocks that you should really get into. Some of the stocks I said I'm not buying. It's not because I wouldn't buy them if I didn't have them. It's because I have them already. There's only one stock, Intel, that I really flat out sold out of. I still have puts sold on it, and it's kind of become a trading stock for me. I'll tell you my thoughts on Intel have really evolved, not because of Intel, but how I think of investing. And that my time frame really, I don't want to go through periods where I have to wait longer than 2 years on a stock to deliver for me. I get to that third year, I'm starting to go, oh, come on, man. I want my money working. So I either want the income from the dividends, or I want the company executing to the point that they deliver. I waited for Spire after my initial purchase to bottom out before I loaded up. Did the same thing with AST Space Mobile. I have not traded Ametis quite as well as I should have. It would be silly not to add to it now if you don't have the allocation that you want. And if you're frustrated because you haven't made money in 2 years because you haven't traded it well, take the summer off. There is a company that has airlines lining up right now to help them build the SAF plant. They do. They're going to have new India contracts in a couple months every year. They're going to IPO India, make hundreds of millions of dollars by IPOing 10 or 20% of the company. And ultimately, that will set a valuation for the India assets. And I'm actively lobbying Eric McAfee, and he won't comment on it. He knows how I feel. I feel like international investments are riskier than American investments, especially regulated investments, especially in the face of decarbonization. I want them to get a valuation on the India plant, and I want them to sell it all. Cut a deal on tallow and sell the rest of it. And reinvest that money into America, because that's where it's safest, and that's where the government's giving you a lot of money to do things. Why not build 2 more plants in America by selling the one in India? And he knows that's how I feel, and I think that he's going to get there. What happens with India for Ametis is that once it's monetized, the American side of the company can not only become debt-free, but it could become debt-free and 2 to 3 times bigger as far as assets. They already have a second property. I believe it's in Kansas. It doesn't do much yet. But where are all the pigs and corn and wheat and soy in this country? In the middle. And there's natural gas out there too. And there's rail line. Ametis can become a very big company. It's just going to take time. Take a look at the chart of Marathon Petroleum. Marathon Petroleum grew by buying companies like Ametis. They bought Tesoro and several other refineries. that were small and grew over years and years, because these are businesses that just don't move fast because you're moving big stuff. It's not software. I mean, have you ever driven up to a refinery? They're huge and complex and need constant maintenance and capex, which is why, for me, I only want to own them when they're expanding and growing, so I know somebody will buy them down the road. At this point, I'm not interested in Marathon Petroleum. But it's a great company, yeah, but it's fully valued. It's just going to be choppy for a while. And if I only have a certain amount of dollars that I can allocate, I want to allocate to the places where I'm going to get the best performance. And since I only need to own around 20 stocks and a few ETFs and some Bitcoin, I can be very selective. I like beta. What is beta? Volatility. I like volatility. Given a chart that's moving up and to the right, one with bigger ups and downs versus one with smaller ups and downs, which one should you actually want if you're going to do any management? You should want the one with the bigger ups and downs. And then you just have to be a little bit better than average to do better than the aggregate line wherever it ends up. Less volatility generally leads to fewer gains or just very average gains because you never get a trading opportunity. And while I only like to trade every year or two on a position, that's more than the people who buy something and they hold on to it for 11 years and then they ask, boy, I really haven't made very much. I wonder what I should do. Well, the answer was you should have bought more volatile stuff to begin with, learned enough about the companies to understand the earnings ratios and the valuation ranges, and done some very simple ebb and flow selling, particularly being an option seller when you're closer to the top or closer to the bottom. That little ebb and flow can add a lot to your portfolio. 5, 6, 7, 10, 15 points a year sometimes, just by using the volatility inherent in the market to sell options from time to time. It's not super sexy, but it's super effective. So I'll end with this last missive to you once again. Learn how to sell options and understand why you do it. There's a lot of speculators. They make those options more expensive than they should be. So you want to sell them, not buy them. Pretty standard, pretty easy. All right, folks, I have writing to do. I have things to publish, stories to tell, narratives to narrate. Have a great day, and you should be a net buyer, not a net seller over the next few weeks. Nibble, nibble, nibble almost daily.